Hello and welcome back to part 2 of Put Credit Spreads. As usual, I hope you all having a fantastic day. If this is your first time visiting my channel, be sure to subscribe as I'm attempting to grow the channel organically by providing informational content. Alright, so what's the topic for the day? Yeah, we're gonna be doing a live put credit spread contract on SPY so that we can learn how to better navigate the ins and out, manage our position, and how we can limit our losses on a losing position, or if it's going our way, how to quickly benefit from it. Before we go into Robinhood and open the put credit spread, I want to make sure that we understand what we're getting ourselves into, because this is basically a contract that we are actually doing, and I want you to understand that, okay? All right. So just to review, we already know that a put credit spread is a combination of two strategies into one contract, in which we are hoping the security share price is not going to decline below or at my sell put strike price, which is going to be my short leg, by expiration date. That was a mouthful. But anyways, we only make money if the share price trades sideways or it rallies up. Okay. Now, what is the purpose of buying the put? Remember, we got the sell put and we got the buy put, which is the other long leg. That's what they usually call it, okay? Well, in the scenario, the share price declines below our strike price, then we can mitigate our losses with the buy put, okay? That's basically the reason why it's there, okay? Now, for example, let's open up a contract with SPY. Man, as you can see, the share price of SPY is at 511.81. That's bad right now for me, for one of my positions. But anyways, as you can see, basically is unaffordable for a lot of investors with a small account, myself included. But with put credit spread, we don't have to worry about that. Okay, let's go to trade. We are going to, the first thing we're going to do is we got to make sure that we are selling a put, because that's the first leg that we are going to open. Okay, we are going to pick an expiration date. I'm going to do it for the 25th, and I want you to notice how the further the expiration date you pick, the more value we are going to pay on the premium. Okay, as you can see, let's take a look back at April 24. You see how the value goes down if it gets closer to our the further it goes out, the more money, the more value it's going to take, as you can see. Okay, that's the point I'm trying to make here. Now, first we pick our sell put leg, and assuming we have done our due diligence on SPY movement and we have evaluated a good entry point, we are going to select a strike price out of the money that hopefully SPY won't decline to. Now, please understand, I am not advising or advertising any of these plays, okay? You have to come up with your own plays. You have to do your own evaluation, because your evaluation might be a lot more different than mine, and you have to come up with your own play, okay? Now, let's select, we're going to pick the strike price right now, and right now, since SPY share price is at 511, I want to go way out of the money. Okay. Either way, let's go pick. We're gonna go out of the money. Okay. What do I mean by going out of the money? Well, we're gonna attempt to increase our chances of not getting assigned, or not only getting assigned, but for this play to not to go against us. Okay. So I'm gonna pick 490. Maybe I'll do 489. Now, this leg is the most important part in order for us to become profitable in this trade. Okay, meaning SPY share price has to stay above our sell put strike price by expiration date. So that way we benefit from it. When we benefit, and what I mean by benefiting from it is basically we get our collateral back and we get to keep the premium that we generate through this contract, okay, or from the trade. Now there are some exceptions that I'm going to be discussing later once we complete this contract, but let's move on. Let's pick 488. That's going to be the first leg. This is also called a short put leg. Never mind that. Make sure that the check mark is there, and now we are going to select our buy put, and I'm going to select a price right below it. Okay. As you can see, the system down below is going to recognize this as a put credit spread. Okay, once we select 148, there it is. You see it? Just to clarify, you don't always have to select the strike price right below your sell put. You can go 2 rows down if you want to. And what this does is that you have a bigger opportunity to receive more premium for that trade, but it's going to take more of our collateral in order to generate that premium. Okay, so let's take a look for comprehension purposes. Let's select the strike price below our sell put, and as you can see, the system is going to recognize that it's a put credit spread. Hit continue. We are going to select anytime soon. Robinhood, come on. Anytime soon. Thank you very much. We're going to select, let's do so right now the limit price is basically how much of not cost. This is how much premium we're gonna get for this. Okay, we can attempt to control that. However, right now the limit price is between $7 to $13. Okay, with $13 would be the less likelihood that getting this contract filled at the moment at the share price of SPY. Now, what can happen is if the SPY share price continues to decline, then the likelihood of this getting filled at $20 is going to increase because it's getting closer to our strike price. So because of that, the premium can actually, go. You have a bigger opportunity or chance to getting this filled. Okay, so let's pretend for example purposes that I put it here for $20, right? It's a low fill likelihood. Okay, now the estimated credit is, like I said, is going to be $20 minus commission. I want to discuss this down below. The max profit is basically if this contract expires in our favor, then the max profit that we can make is going to be $20, okay, at the end of the contract. If it goes our way, the break-even point, we're going to skip that because I don't want to get confused, or I don't want to confuse you guys. And the max loss is basically the collateral minus the premium that we initially receive from opening this contract, which is going to be $20. Okay, so right now this contract right here is going to be a collateral of $100. That's how much collateral Robinhood is going to hold from us for opening this contract. Okay, now for doing this contract, we are going to receive the $20. Okay, that's the premium. That's what we're actually betting for to win. But again, if the contract goes against us, and what do I mean by that? It basically SPY by expiration day declines way below our strike price, which is our sell put. And if it does that, then we are starting to lose value on our on this contract. Okay, let's review it. And as you can see right now, it's going to be $100 of collateral My strike price is 488, and I'm hoping that SPY does not decline to 488 by expiration date. Because if it does, then we basically losing on the contract. It's actually going against us. Okay. Now I want to do another example. Remember earlier I picked the sell put. What was it? 490. Anyways, let's just pick whatever. Because I'm not gonna go through it. 195. Then we're gonna pick a buy put right below the 491. Now this time, instead of picking one below our strike price of the sell put, we're gonna pick two down to see if we can generate more income. Again, the system is going to recognize the put credit spread. We're going to hit continue. And as you can see right now, we have the opportunity to make $50 of premium on this contract right here. Now, what's the difference? Well, the difference is that this time, instead of putting $100 of collateral, look at how much it's going to cost us. It's going to cost us $400 of collateral. Okay, so it is really up to you if you want to play it that way, or if you just want to put at risk $100 of collateral or $400 of collateral. So it's really up to you. Okay, but I just wanted to show you that. Now, all right, so we got that out the way. I already covered the max profit and the max loss. We are going to discuss how to manage the contract once we have that contract and is actively filled, or it has been actively filled, and now we're just waiting to see how it's actually going to end up. I already have one active contract, and here it is. We have this put credit spread right below at 526, which is the short leg, and the 525 put, which is the long leg, which is basically the buy put. Okay. Right now, as you can see, they're asking $66 to close that contract. Okay. Now, if right now the share price of SPY is a 511, so right now this is going against us. Okay, so we are losing on this trade. However, expiration day is in a few days, so we still got about 3 more days to see how SPY is going to perform in the next 3 days. You never know what can happen. It can continue to decline, or it can actually start rallying, and our contract might start losing value, which is exactly what we need. Okay, we need for it to lose value, so that way we can either close the contract for a little chunk for a few dollars, or let it expire worthless. Okay, all right, so let's do it. Let's pretend that right now we are going to close this contract. However, I want you to notice a couple things here. The average credit, that represents how much premium we initially received for opening this contract. Okay, so remember when we got it filled at first, I know not this one specifically, but in my previous example, we went through how to get it filled. So I was able to receive $32 from this contract here. Okay, now right now the market value and the current price of it is $66. Okay, and this is basically how much my contract is worth at the moment. Okay, this is the value of that contract. So if I would want to close this contract, it would have to be between, let's see how much they're asking. Let's do trade. Let's go to close. And it's between $55 to $76. And then once again, we don't know if it's gonna get filled or not, because we are totally relying on SPY share price movement. Okay. Once again, I already explained that this contract right now is going against us, because SPY is way below my strike price. Okay, my strike price was I think was 526, and right now SPY is just declining, declining, and declining. So right now my contract is in the money. That's what they call that. Why is it in the money? Because it's way, I'm paying too much for it if I would get a sign. Okay, now we can play with this. Let's say that instead of they're asking 54 to 77, I can do, you know what? I'm willing to close this contract for $25. Okay, that's the estimated cost to close it. What's going to happen? We're going to review it, and for if it goes through, okay, and I'm able to close it, which the likelihood of this getting filled is very low, just so you know, because the contract right now has a different value. It has a way higher value than $25. But if that would actually go through, then they would release my $100 of collateral, and I get to keep the $32 that I made from the premium. And regardless if this a contract expires and I lose all of my collateral, regardless, I still keep the premium from the beginning for opening this contract. Okay, so right now, if I was able to fill this, to close this contract with $25, we would make about a $7 profit minus commission fees. Okay, commission is probably like 8 cents or 16 cents, something like that. I can't remember because since it's two strategies into one, it's double. So yes, I would be able to make about, what was it? $6 and something cents. Okay, if it gets filled. Okay, right now, once again, I still have 3 more days. I'm not going to go through with this because I feel that maybe not today, maybe tomorrow, SPY my rally, and this contract might become a little bit less expensive or a bit more affordable to close, and me being able to profit from it a little bit more than $7. Okay, alrighty, let's see. As I already explained, we got 2 factors that can possibly benefit us in closing our contract our way. Okay, and those are basically time decay, which is the theta, and the share price movement. Okay, so for every hour that passes and the share price movement is moving sideways, the contract's value will continue to decrease because we still have 3 days, and every day that it passes, the value will continue to go down. Okay, so time is decaying the value of our contract as long as SPY share price stays either trading sideways, or if it rallies, that's even better because then it's actually going to lose more value. Okay, and what I mean by lose more value is basically our contract. It's going to lose a lot more value. Okay, now that's what we want. We want our contract to lose more value so that we can close it, and we can close it affordably and attempt to keep a better profit. Okay, in the contrary, if SPY share price decreases below our sell put, which is already is, and it keeps decreasing more, then the value of our contract is going to continue to increase, and we're going to be deep in the money. Okay, we don't want that because then it's going to become a little too expensive to close, and then we're not even going to be able to close it to get our collateral back, because maybe even it'll cost us more than $100 to close that contract, and we don't want that. Okay, for that you might as well just let it expire worthless. I mean, not expire, worthless, but you would let it expire and we lose our collateral, and I'll just keep the $20 or the $32 premium that we generated through for doing the the actual contract. Okay, so in reality, we don't lose the whole entire $100. What we're losing is basically $100 minus the $32 that we got from the premium. So yeah, basically that's going to be our loss. Now, there is an additional possibility we could do if we continue to lose on this contract, right? We could attempt to roll it and extend the contract for more time. However, everything has its pros and cons, right? This can cost us an additional collateral depending on how deep underwater the contract may be, how low of a strike price you want to move your new strike price. Okay, like for example, right now, since I'm at 526, if I'm gonna roll, I want to roll down instead of keeping the same strike price, because that gives me a better opportunity to win on this contract, on this bet, right? However, if you do that, it's gonna cost us more money. Just so you know. Okay. Now there are some strategies that we could deploy in terms of rolling contracts, but for the sake of video time, I'm gonna spare you the TED talk and leave it for another video. Okay. Now, one more thing I want to discuss, and this is basically early assignment. Okay. With early assignment, two things can happen here. If you have the sufficient buying power of covering the sell put, which is basically the 100 shares of buying SPY at 526 for each share, they will assign you the 100 shares of SPY at that price. Okay, now if that happens with early assignment, okay, early assignment is basically the buyer of that sell put that you open a contract with, they decided to exercise it, okay, and they say, you know what, this is worth the time, the mutual agreement that we agreed upon at the beginning, and they decide to exercise. Now, you're gonna get the 100 shares at 526 each. That's basically you're gonna get assigned. What you can do is that's the reason why we buy the put to exercise against that early assignment. How does that work? Well, you get the 100 shares, right? Robinhood is going to send you a notification talking about, hey, you got to sign 100 shares of SPY at 526. Now, what you can do is you're going to locate the other leg, which is in this case is going to be the long put, which is the buy put, which is right below, right over here. This is the reason why we buy those puts, so that we can mitigate our losses, or we can control our losses. Okay, let's select it, and we're going to scroll down, and we are going to exercise. Okay, as you can see right here, I'm not going to exercise, I'm not going to go through it with the whole entire thing, but this is the reason why we buy the put, so that we can exercise against our assignment. And what that does is the 100 shares that you were assigned at 526, you are going to sell by exercising your buy put. You're going to sell it back to the market at 525. Which is right up here, meaning that you're basically losing only the collateral that you initially placed from the get-go, which was only $100. Okay, that's basically what happens. One leg eliminates the other. Sometimes when you get early assignment, Robinhood might not exercise that for you. They just assign you the 100 shares. And if that happens, then the following day, you can come back, locate your buy put, and exercise it against it. And then you sell the 100 shares of SPY at 525. That is if you don't want to keep the 100 shares at 526 of SPY, which in my case, I do not want to because I am paying way too much for them. As you can see, the price of SPY right now is at 512, right? So why would I want to get 100 shares of SPY and pay $525 for them? Not worth it, right? So that's the reason why I exercise the buy put against it. Okay. Hopefully that makes sense. I know I threw a lot of concepts out there for you today. I know if you are a beginner on put credit spread, this is a lot, but hey, that's why the video's here. You can review it. If you have questions, you can comment down below. And I'm always around. I always reply to my comments. And hopefully this was I guess informative. Hopefully you find something beneficial from it. And I guess that'll wrap up the video for today. Once again, subscribe if you want to. Like the video. I'm gonna continue to drop more videos with more informative stuff. Or strategies, because that's what this channel is about. It's about strategies. And that's what I have for today. Thank you so much for your time. I hope I was able to keep you engaged. I will see you on the flip. Strategic investor out, checking out, and take care.